The latest data suggests mortgage delinquencies are rising as the number of mortgaged households increase. And yet the RBA is bullish about future growth prospects. And that's despite anemic retail spending, a stronger dollar, and home lending reaching another new record. So what's going on? Welcome to the latest Property Imperative Weekly, to the 5th of August 2017. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics, with this week's review of the latest property and finance news. We released our mortgage stress and default modelling for Australian mortgaged households to the end of July 2017. Across the nation, we estimate that more than 820,000 households are now in mortgage stress, and that's compared with last month's 810,000, with 20,000 of these in severe stress. This equates to more than a quarter of borrowing households. We also estimate that nearly 53,000 households risk default in the next 12 months. We've been tracking the number of households in stress each month since 2000. And since a small easing in February 2016, the number under pressure has been rising each month. The RBA cash rate cuts provided some relief, especially directly after the GFC. But now mortgage rates appear to be more disconnected from the cash rate as banks seek to rebuild their margins. There were more mortgage rate changes this week, with, for example, Virgin Money increasing the standard variable rates for owner-occupied and investment interest-only loans for new and existing customers. And they also increased the fixed interest-only rates for both owner-occupied and investment loans. The increases range from 15 basis points, or 0.15%, up to 50 basis points for a 3-year lower LVR owner-occupied fixed loan. Teachers Mutual Bank increased the interest-only variable rate by 20 basis points to 5.66%. Interest-only rates for the Solution Plus home loan rose by between 30 and 50 basis points, depending on the LVR. Rates span between 4.49% and 4.67%. They decreased rates for the principal and interest home loan by 15 basis points to 4.39% for those borrowing between $240,000 and $499,999, where the LVR is greater than 80% and less or equal to 90%. CBA doubled the waiting period for customers seeking to switch to an interest-only repayment loan from 90 days to 180 days. This is a further move to try to reduce the proportion of interest-only loans held following regulatory pressure to meet the 30% limit. CBA has already lifted interest rates, tightened lending criteria, and throttled back applications via mortgage brokers. So standing back once again, we see a differential shift, with interest-only loan rates being lifted, whilst rates on some owner-occupied principal and interest loans below specific LVRs and values are reduced. This underlines the current behaviour where specific types of low-risk borrowers are being recognised. Expect more of the same from other market participants. A new report by the Australian Housing and Urban Research Institute, AHURI, revealed that an estimated 1.3 million households, and that's around 14% of Australian households, are in housing need, whether unable to access market housing or in a position of rental stress. This figure is predicted to rise to 1.7 million by 2025. This includes 373,000 households in New South Wales, where the number is expected to increase by 80% to more than 670,000 by 2025. The newly released Household Income and Labour Dynamics in Australia, HILDA, data showed that home ownership among 18 to 39-year-olds has fallen from 36% in 2002 to a new low of 25%. On top of that, between 2002 and 2014, the average mortgage debt of young homeowners increased by 99% in real terms, from 169,000 to 337,000. In fact, the decline in home ownership has been greater than the decline in owner-occupied households. This is largely because adult children are living with their parents for longer. More broadly, Hilda also highlighted growing inequality, something which we have been discussing for some time. It is parents passing wealth down to their children that are once again starting to define who gets into property and who does not. We're going back to a 1950s style class division. Our research suggests that the average hand down from the bank of mum and dad is now more than $85,000. This rising inequality was also confirmed by the latest Emmy Bank survey. They say the overwhelming majority of Australian households, 68%, saw their income stagnate or fall. Only 32% got pay rises, the lowest in 3 years. And there are other barriers to property purchase as well. Data from the HIA suggested that the average stamp duty bill paid by an Australian owner-occupier increased by 16.4% to $20,725 over the past 12 months. And that's nationally, with the average cost in Sydney and Melbourne, Australia's most expensive housing markets, where just under 40% of Australians live, substantially higher at $29,150 and $26,870 respectively. The median dwelling prices in both these cities has more than doubled since the start of 2009, according to CoreLogic. The HIA says recent changes to stamp duty in New South Wales also means that foreign investors now pay almost $100,000 in transaction taxes to acquire a standard apartment in Sydney, almost 4 times as much as local buyers. Fitch Ratings said Australia's mortgage arrears increased by 12 basis points quarter on quarter to 1.21% at the end of 1Q17. Due to seasonal and Christmas holiday spending and possible difficulties faced by consumers because of low real wage growth. Suncorp underwhelmed the market with their FY17 annual results. Their housing portfolio now sits at $44.8 billion, up from $44.27 billion in 2016, with 66% coming from the brokers. The results were helped by overall lower provisions and the repricing of mortgages, but despite this, bank net interest margin fell. Past due home loans rose from 0.79% last year to 0.85% this year, and they have significant portfolio concentrations in Queensland and Western Australia. Genworth, the listed lenders mortgage insurer, released their 1H17 results, and as a bellwether for the mortgage industry, we see continued pressure on mortgage defaults, up 5 basis points to, in WA, 0.86% and Queensland 0.72%, and a fall in higher LVR lending, leading to lower volumes of new premiums being written, but at higher prices. The average original LVR of new business flows in 1H17 was 82%. The latest credit aggregates from the RBA to June 17 shows continued home lending growth, up 0.5% in the month or 0.66% annually. Business lending rose 0.9% or 4.4% annually, and personal credit fell 0.1% or down 4.4% over the past year. However, they changed the seasonally adjusted assumptions, so it's hard to read the true picture, especially when we have still significant reclassification going on. The net value of switching of loan purpose from investor to unoccupied is estimated to have been $55 billion over the period of July 15 to July 17, and $1.3 billion occurred in June 2017. In original terms, housing loans grew to $1.69 trillion, another record. Investor home lending grew 0.5% or $3.3 billion, but this was adjusted down in the seasonally adjusted series to 0.2% or $1.13 billion, Owner-occupied lending rose 0.9% or 9.83 billion in original terms, or 0.7%, 7.34 billion in adjusted terms. APRA's latest monthly banking statistics for July 2017 reconfirms that growth in the mortgage books of the banks is still growing too fast. The value of their mortgage books rose 0.63% in the month to 1.57 trillion. Within that, owner-occupied loans rose 0.73% to 1 billion plus, whilst investor loans rose 0.44% to 522 billion. Investor loans were more than 35% of the portfolio. The monthly growth rates continue to accelerate, with both owner-occupied and investor loans growing, and that's despite weak regulatory intervention. On an annual basis, owner-occupied loans are 6.9% higher than a year ago, and investor loans 4.8% higher, both well above inflation and income growth. And so household debt looks to rise further. The remarkable relative inaction by the regulators remains a mystery to me, given these numbers. Whilst they jawbone about the risks of high household debt, they are not acting to control this growth, and they do not seem that worried. Indeed, the latest RBA statement on monetary policy, released on Friday, appears to be very upbeat. Despite forecasting growth down a bit in the near term, they are still holding the view of growth of 3% plus later, supported by improving international economic outlooks, a rise in business investment, strong exports, and low unemployment. If this is correct, then it seems to me conditions will be right to lift the cash rate towards the neutral position, which, as we saw recently, they hold to be 2% higher than the current levels. That said, many economic commentators think the RBA is overly bullish, given high household debt, flat income growth, and risks in the property market. Within the statement, they acknowledge that slow real wage growth is likely to weigh on consumption, especially if households expect the slow growth to continue for some time. And ongoing expectations for low real wage growth remain a key downside risk for household spending. The recent sharp increase in the relative price of utilities poses a further downside risk to the non-energy part of household consumption, to the extent that households find it hard to reduce their energy consumption. And they say this is likely to have a larger effect on the consumption decisions of lower income households. They also make the point that some households may also feel constrained from spending more from their current incomes because of elevated levels of household debt. This effect would become more prominent if housing prices and other housing market conditions were to weaken significantly. Household debt is likely to remain elevated for some time. Housing credit growth overall has been steady over the past 6 months, they said, but has continued to outpace income growth. That said, the composition of that debt is changing as lenders respond to regulators' recent measures to contain risks in the mortgage market. Investor credit growth has moderated, and loan approval data suggests this will continue in coming months. Also, new interest-only lending has declined recently in response to the higher interest rates now applying to these loans, and other actions by the banks to tighten lending standards. So the RBA held the cash rate again on Tuesday and said rent increases remain low in most cities, but investors in residential property are facing higher interest rates. There has also been some tightening of credit conditions following recent supervisory measures to address the risks associated with high and rising levels of household debt. Growth in housing debt, they say, has been outpacing the slow growth in household incomes. The latest Australian Bureau of Statistics retail trade figures showed that the trend estimate for Australian retail turnover rose 0.4% in June 2017, the same rate as in May. Compared to 2016, the trend estimate rose just 3.6%. The trend by state shows Tasmania and ACT ahead of the average, with Western Australia and the Northern Territories continuing to trail. So, standing back, we have a mixed picture, but one where household debt is still rising, income remains under stress, and costs are rising. As a result, we think the drag on growth is stronger than the RBA suggests. Pressure on budgets will constrain spending. But here's the thing. If the RBA is right, we should expect cash rate rises sooner, adding more pressure on household budgets. So it looks like heads you lose, tails they win. Borrowing households will remain under the gun for some time to come. And the property market is at the centre of the storm. And that's the Property Imperative Weekly to August the 5th, 2017. If you found this useful, do subscribe to get future updates. And thanks for watching.